All right, good afternoon. Today we're going to cover some of the basics of mutual funds and how mutual funds work. An awful lot of people come up to me and say, hey, you know what? I just invested in a couple mutual funds. Do you think that's a good idea? And typically I say, well, what kind of mutual funds? Well, my broker put me into a couple funds with Fidelity or Vanguard, and I'm just curious if you think that's a good idea. And I'll say, well, what is in the mutual funds that you purchased? And most people say, I don't know, it's just a mutual fund. Well, a mutual fund is just a container. It's a way of organizing investments. That would be the same thing if you came up to me and said, hey, you know what? I'm taking a class at Citrus College. Do you think it's going to be hard? And I would say, wow, I have no idea. What's the class? Oh, no, it's at that community college, Citrus College, over in Azusa area. And I go, okay, what kind of class is it? What's the content of the class? And they go, I don't know, right? Because a class at Citrus College could be extremely hard. It could be the fourth or fifth physics class in a sequence, and not a lot of people pass it. Or a precursor to engineering, so it's all statistics and trigonometry. Or the class could be Introduction to Softball, in which it's going to be a one-unit PE class, and if you go to the class, show up all the time, and you're basically a good sport and learn a little bit about the rules, you're going to get an A. That's going to be a very, very easy class. If you just tell me you have a class, I have no idea. A mutual fund is kind of like the college. In other words, the college is organized in such a fashion that there's classes within the college. And then within the classes is the actual content of what you're going to learn. Mutual funds are very similar. You have the mutual fund company, like Fidelity or Vanguard. They're the two largest around. And within that mutual fund company, there's a whole bunch of individual mutual funds. And within those individual mutual funds are then the actual investments. So within this mutual fund that is typically operated by a mutual fund manager who's going to control those investments, we could have stock, we could have bonds, we could have gold. So almost anything can be in here. We can have really risky stocks. We could have risky bonds from companies who may or may not be making it, and so they're what are called junk bonds or high yield bonds with high interest rates. Or they could be very, very safe bonds, short-term bonds from big companies such as Home Depot, General Electric, Johnson & Johnson, Walmart. Or we could have gold in there, where we're actually holding one of two things. Either gold bullion, and so it's going to be directly the rise and fall of gold, or we might own gold manufacturers. So these funds can be very safe, or they could be very risky. Let me give you an example of two. We could have two mutual funds. One mutual fund is very risky, and one mutual fund is very safe. This mutual fund might have mostly certificates of deposits from large banks. And so it's all going to be 1 year, 2 year, and 3 year CDs, certificates of deposit. Right now, interest rates are at a real low, so these probably are going to average about 2%. So right now, that fund is a positive 2%. When interest rates are really high, if we go back 15 years, if we go back to the early 70s, interest rates were very, very high. And so when interest rates are at a high, my 1, 2, and 3 year CDs will be 5, 6, 7%. And so if yields are high, we're going to have a 6% rate of return. So this fund is going to be incredibly stable. odds of it losing money is almost nil, and the bottom end return is going to be a positive 2%. The high end return is probably going to be a positive 6%. There's not a lot of deviation here. This would be the type of investment we would put the down payment for our house in. We sold our house. I have $75,000. I'm going to buy another house in 2 years. I want it to be very stable. This would be a good investment. You're not going to get a heck of a lot of return, but you're not going to lose your money either. Then I could have a fund that's very risky. And this fund might invest solely in transportation stocks. So stocks that are moving people or moving freight. And so within this fund, we might see something like Ford. We might see U.S. Air. We might see other companies that provide parts to aircraft. So a part manufacturer. We might see GMAC financing. They get an awful lot of money off automobiles. We can have GMAC credit. We might also have a locomotive company. We might have a freight forwarder company. And so all these companies that transport people and stuff throughout the United States. When times are good and there's lots of money around, these companies do very well. People are buying lots of cars, so Ford does really well. U.S. Air, people are traveling. They have the extra money to travel. They're booking lots of airline tickets, so that's going. If we're driving our cars a lot and buying new cars and our airplanes are out flying lots of miles, we're going to need an awful lot of parts. And so part manufacturing companies do well. Also, the financing companies that are attached to cars, that are attached to airlines, they're going to do well also. So this is going to be extremely profitable in the good times. This could easily return a plus 28%. Very easily. However, if times are bad, in other words, all these companies within the fund do very poorly. We hit a recession, so everybody stops buying large SUVs and the large trucks in which Ford makes the most money. U.S. Air, people stop writing airplanes nearly as much. And so all of a sudden profits start to fall. And they have to cut prices. And then they start cutting routes. Right? Our parts manufacturers are going to be selling a lot less because people are driving less, planes are flying less. In fact, some companies are then going to stop buying parts because maybe they parked an airplane that they're not using, and they're just going to cannibalize that airplane for a bunch of parts. And then GMAC credit certainly is going to be doing poorly because if people aren't buying cars, they don't need financing, so they're not financing a lot of cars, so their profits are down. So we could actually then have on the downside, we could have a negative 35% on the downside. And so if you look at these two mutual funds operated by mutual fund managers who have different objectives, we could end up with a very, very safe, conservative mutual fund or a very, very aggressive mutual fund. There are about 3,000 different mutual funds easily operating in the U.S. There's funds that just buy bonds, just buy large U.S. companies, just buy small U.S. companies, just buy international stocks. And so we've got lots and lots of different mutual funds. And now I'm going to talk to you about my favorite mutual fund by far. My favorite mutual fund is the S&P 500 index. The S&P 500 index is a mutual fund that holds the 500 largest U.S. companies. And so the fund manager goes out and buys the 500 largest companies. So with that, we're talking about Pfizer, Walmart, McDonald's, Johnson & Johnson, Home Depot, all these big players in the U.S., companies that tend to be managed incredibly well. One of the great things that an S&P 500 index gives you, or really any mutual fund, is I can buy into this mutual fund with, say, only $1,000, plus I'm going to add maybe another $250 a month of my money, and I get little pieces of that mutual fund so that I own a little bit of all the different 500 companies. It allows me to get a lot of diversification within any sector. Within the S&P 500 index, there's also an extremely popular index called the Russell 2000. What it does is it buys the 2,000 largest companies, and so it gets that next notch down to some intermediate-sized companies. There's also what's called the Wilkerson 5000, which buys the 5,000 largest companies, so it takes in an awful lot of smaller stocks. But in my opinion, the best starting point for pretty much any investor is the S&P 500 index. Okay, we're going to get into some of the nuts and bolts of how a mutual fund works. We now know that some mutual funds are aggressive, and they can have great rates of return, and they can lose a lot of money. Also, some mutual funds are incredibly conservative. They're not going to make a lot of money, but they're not going to lose money for you either. And you need to decide how much risk you want to take, and you need to decide which funds you want to be in. But we're going to go over kind of how a mutual fund works. Mutual funds are set up so that individuals can pool their money together and be more efficient in buying. So we have a mutual fund, and we have a mutual fund manager. The mutual fund manager will typically have a stated objective of what he's going to buy or what she is going to buy in that fund. And typically it'll be, say, a paragraph. It might say, we're going to buy the S&P 500 index, the 500 largest companies in the U.S. We're going to buy transportation stocks that are engaged in international transportation. We're going to buy railroad stocks. We're going to buy airline stocks. There are a lot of funds that are out there, and they're buying just precious metals. So they're buying gold. They're buying platinum, silver. Some funds just buy commodities, and so they're buying copper, zinc, cocoa, coffee, bacon, right? All that good fun stuff. So the way this operates is we're going to get three of us over here, and we're all going to deposit $100 into this account. That gives us $300 in our account. The mutual fund manager will now create shares, and the mutual fund manager, to start the fund, will decide how much the shares are going to be. And so let's say he decides $10. So he's going to ship to each person here who invested $100 each 10 shares each. Once we have our shares, the initial amount of money that we put into our mutual fund really doesn't matter. What matters is the number of shares I have within this company and what the share price is. The way we figure share price is we take what's called net asset value. Net asset value is all the money that is in this account, all the stocks, bonds, gold, everything of value, and we subtract out of that any obligations they have, trades that they haven't funded yet, back salaries. Maybe they've borrowed money to buy other investments, back rent, all that type of stuff. So for this fund, we're going to say that they have none of that. So their net asset value is $300. And then we're going to divide that by the number of outstanding shares. How many shares exist? Well, we created our fund. We put in $300. He created shares in the mutual fund and shipped shares in the mutual fund to each person, 10 each. So we're going to divide 300 by 30, and we get $10. So if each shares were $10, 10 times 10 is 100. So we got back our original investment. So some time goes by, and lo and behold, we've picked some really good stocks within this mutual fund, and the stocks double in value. Now, they're worth $600. If we're looking at how much the stock is selling for, the new net asset value is $600. So we erase our 300, and our net asset value is $600. The number of outstanding shares stays the same, still 30 shares outstanding. So our new value is $20. $20 times 10 shares that each person has means we have a value of $200, which is twice our original investment, i.e., we doubled it over here. So now one of these individuals says, okay, I want my money back because now I'm going to buy a pool. I'm going to go on vacation. I'm going to send my kids to college. For whatever reason it is, they want their money back. So what the individual does is they take their shares, they actually send their shares back to the mutual fund manager. The mutual fund manager destroys those shares. They're technically destroyed. When you're invested in a mutual fund, if this mutual fund owns, say, General Electric, and they own shares in General Electric, you do not own shares in General Electric, you own shares in the mutual fund. So when these are redeemed, they are destroyed. If you're buying regular stock through General Electric, Ford, Home Depot, when you buy that stock and you decide you don't want it anymore, you sell that stock to another person. The shares are not destroyed. So we're going to send these shares back to the mutual fund manager who destroys those shares, and then he's going to liquidate, he's going to sell assets to pay this person off. So he sells $200 worth of assets to pay him off, leaving $400 in my fund. This person over here no longer has the shares, and they have their $200 back. If I look at stock price, now I have $400 in net asset value, but I only have 20 shares of stock because these 10 were destroyed. So therefore, during this redemption process, where this person here redeemed his shares, the value that these individuals have was unaffected. Whenever you buy shares from the mutual fund or you redeem them back to the mutual fund, you always buy and sell at the share price that is calculated on net asset value. So now another person comes along and says, wow, this looks like a great fund. I want to invest in this fund. Let me in. It's doubled in value. So we bring in another person. And they want to invest $100. So they're going to take their $100. They send it on in, bringing my total in my fund to $500, and then the shares are going to be issued. Now, we issue not 10 shares because the price per share is $20. So we're going to issue 5 shares of stock. This person's going to get 5 shares. When we recalculate our share value, we now have $500 with 25 shares outstanding. 25 into 500 is 20. So the redemption or the addition of new money has no effect on the rates of return of the individuals who remain in this fund. There's a couple things also that mutual funds do very, very well that it's hard to replicate. Within our mutual fund here, if this is the S&P 500 index, they're going to own 500 different companies. And when I buy into this fund and put my money in the fund, I get a return based on all these companies within the fund. If I want to join most funds, most of them have two different ways to join. Either you deposit $10,000 into the fund, or an awful lot of funds have a start amount at $500. And if you start at $500, usually they're going to demand that you're going to make additions through automatic deductions. So we can start our account here with $500, and we can add $250 every single month. And that gets us access to the 500 largest companies. If I went out on my own, not through a mutual fund, I might have to buy one share of stock at 38, one at 42, one at 61, one at 120, one at 14, and then I've got all these different stocks that I'm buying. Each time I buy one of these stocks, I also have to pay a transaction cost. So I'm paying maybe $5, $6, $8 for each and every one of these trades, and it's going to take forever for me to have enough money to buy one share of 500 different stocks. When I finally do buy one share of 500 different stocks, I will have paid so much in transaction costs that it's not even worth it. It's going to be a money-losing proposition. Okay, one more item that I want to talk about in the introduction to mutual funds. Mutual funds are kind of broken into two different kind of categories. One is an actively managed fund. What an actively managed fund means is we've got our mutual fund manager, and behind him he has a whole bunch of analysts who are going to go out and they're going to try to find the next hot stocks, the next hot sector. They're going to try to say, this company should outperform all these other companies. And so, therefore, let's buy a lot of this company, and let's not buy any of that company. On average, these funds tend to beat the market unless you consider transaction costs and you consider their fees. So the long-range average of the stock market is 10%. And we're just going to make up a number for simplicity and say that this fund returns 11.5%, which is really good, right? And they got a whole bunch of analysts out there who are getting paid $250,000 a year, $500,000 a year. If they do really well, they might get $1 million bonus each. So it's an expensive fund to run. And so the overhead of this fund often runs, say, 2%, which means after expenses, which is really what you want to consider when buying mutual funds, not what the rate of return within the fund is, what's the rate of return after expenses? In this example, it would be 9.5%. Because really, if I've got a financial analyst who is picking stocks for me, and he gets a 90% rate of return, but takes 85% of it and I'm left with a 5% rate of return, that sucks. I mean, that's not a good rate of return. I don't want that. I want to know after fees what I'm going to get. So we've got an actively traded fund. The other types of funds are called indexed funds. An index fund is basically a fund that has some predetermined formula of how it's going to operate. So the S&P 500 index, which, by the way, about 85% of all my retirement assets are actually in the S&P 500 index. The S&P 500 index simply says we are going to buy the 500 largest companies in the United States. And Standard & Poor's, which is what S&P stands for, independently says what the 500 largest companies are. Each year, one or two fall out because they shrink, they go bankrupt, and we've got companies that are growing, so one or two are going to be added in. So as new money comes in, they don't go out on safari looking for something. They just have maybe an accountant or two to keep everything straight. And they divide up the money on a predetermined formula. So if they return the average rate of the stock market, which is about 10%, and both Vanguard and Fidelity, the two largest mutual fund companies, are very aggressive at keeping their expenses down on index funds. And the expense ratio is about 0.1% on the S&P 500 index, which means my return after expenses is 9.9%, beating the actively managed and actively traded funds. And if you're in a taxable account, a lot of times these generate a lot more tax liability, where the tax liability in index funds tends to get deferred. So what we want to do here is we want to look at the after expense rate of returns.